Big presidential debate, right? We're going to hear a lot of mudslinging, a lot of insults, I'm sure. Some of you may be excited to watch this political grandstanding. I don't know. But one crisis that, if I was a betting man, I would say we probably won't hear much about tonight at the debate is the burgeoning debt crisis in the United States, also worldwide. We just got some information from the Federal Reserve yesterday regarding consumer credit in the United States, and it really exemplifies just how significant this debt crisis really is. At all levels of society, individuals, corporate, government, debt is hitting record all-time highs. And this is going to have severe implications for the value of the US dollar. It's also going to be very important for the price of gold and the price of silver. We're going to get into that in today's live stream. But starting with this consumer credit report, we've got record consumer debt. It was up 6% in July. That's if you annualize the rate. That's the highest rate of increase for consumer debt since 2022. Also, the absolute level of consumer debt right here at over $5 trillion has now hit a record all-time high. Got a surge in revolving debt. So that means credit card debt, home equity loans, things that people are usually using for consumption. They're facilitating consumption with the expansion of consumer debt. Now, this comes at the same time that the personal savings rate is at the lowest level since the lead up to the great financial crisis. Right now, personal savings rate here from the Fed is at 2.9. The last time we were this low was back between March of 2008 and February of 2005, the lead up to one of the greatest financial crises in living memory, the inflation of massive bubbles on the back of consumer spending. Remember the GDP print? We recently got that nice hot GDP print, showed how well the U.S. economy was doing. Well, that was all a result of an increase in consumer spending, and that is because consumers are draining their savings. They are loading up on new debt to deal with inflation. And all of this debt, which is about to get much worse, by the way, we'll talk about why in just a moment, is going to lead to massively higher inflation and debasement of the U.S. dollar. Now, also, I'd like to point out that right now, this is the interest rate on credit card plans. It's at a record all-time high. You can see that right now, as of May 2024, the rate was 21.51%. It's even higher than that today. And so consumers are racking up record levels of consumer debt at a time when they are paying a record high level of interest on that debt. And this goes to show you just how this system is set up to really transfer wealth from the most vulnerable people in society, those who are relying on credit cards to facilitate consumption, to the wealthiest members of society. Now, you also have the U.S. national debt. It's not just consumer debt. We've got the U.S. national debt now at $35.362 trillion. That is a big move up. I remember it was not too long ago we were talking about the threshold of 35 trillion, right? So I think we're going to hit 36 by the end of the year. The deficit is exploding at the government level as well. And, I want to talk about what is coming up in terms of the Federal Reserve's plan to cut interest rates in as little as, 9 days now, I think, 8 days. We've got the FOMC meeting kicking off. So in light of this massive expansion of debt, elevated inflation levels, which remain high, the Fed is about to cut rates. If you look at the CME FedWatch tool, currently the estimate is 29% chance of a 50 basis point cut, 71% chance of a 25 basis point cut. Doesn't really matter. The Fed is getting back to easy monetary policy, and that is going to create a huge surge of new debt. Now, why does that matter? Why does this surge in debt and borrowing matter? Well, let's look at the old definition of inflation. If you're new to the channel, you might not be familiar with the fact that the word inflation, it's actually been redefined over the past 50 years. I remember in 1971, Richard Nixon took us off the gold standard, and since that time, the word inflation has been redefined in the dictionary. Now, why is that? Well, the current definition of inflation, if you look it up, it just says increasing prices, basically. And you get people like Jerome Powell, the chairman of the Federal Reserve, who will tell you, well, we know how little we know about inflation and things like this. Like, it's a mystery where the inflation comes from. But if you go back to the old definition from 1971, that year that Richard Nixon ended convertibility of the dollar into gold, the old definition is the act of inflating, the state of being inflated, or a sharp increase in the amount of money and credit causing advances in the price level. So embedded in the old definition is what causes the rising prices, and that is the expansion of the money supply and credit. And what is credit? Well, credit is debt, right? So the more people borrow, the more entities borrow, more nations and corporations borrow and spend into the economy. That is an expansion of the money supply. And as the Fed is preparing to cut rates, that means that there's going to be a lot more of this. And it's not just the Fed cutting rates. There's a couple stories I want to cover with you today. Before we go any further, I do want to say a thank you to today's video sponsor. Oh, that's not it. Here we go. SD Bullion. Now, I know that today's debate, a lot of people on the channel here, a lot of people who view, you may feel one way or the other. If you like Donald Trump, now I'm ambivalent about politics, you know that, but if you like Donald Trump, you can go to sdbullion.com/Trump. They've got all these nice Trump-trained bars, coins, rounds, you name it. If you're in the other camp or you're like me, you're kind of a political agnostic, they've also got American Silver Eagles on sale right now. So something for everybody over at SD Bullion. But if you want to, show your support for your candidate, at least if it's, Trump, you can go to sdbullion.com/Trump. So check them out with the link in the description. Now, I want to talk about Jerome Powell and cutting here, because he said recently that the Fed won't wait until inflation is down to 2% before cutting rates. Okay, that's fine. Why did he say that? Well, he says that he feels there could be some lag. He doesn't want to, let inflation drop too low. But I want to contrast this against his previous position. So right now, the PCE index, this is the Fed's favored measure of inflation. I think the reason that they like this one so much is that it tends to understate inflation the most. But right now, the rate of the PCE is 2.5%. So 0.5% above the Fed's target of 2%, right? And Powell is saying we don't need to wait for inflation to get all the way down before we start cutting. Now, the real reason they need to cut is because there's so much debt, right? And it's a huge crisis. And the system that we have is addicted to new debt. So the Federal Reserve has to cut, even though it's going to send inflation much higher. And, the way you can kind of get a glean into which way the Fed, you can glean some insight, rather, into which way the Fed will fall when it comes to inflation and interest rates is you can just think about right now we're at 2.5%. We're 0.5% above the inflation target of the Federal Reserve. And then if you look at this chart from Trading Economics, it kind of shows a chart of where the PCE index is, the annual rate of change. Now, if you will go back to January of 2021, the PCE was at 1.6%, right? So it's 2.5% today, 1.6% then. So it was actually closer to the target of 2%. But did Powell say, now we need to stop buying U.S. Treasuries? Do we need to hike rates because, inflation might go up even if we act now? There might be lag between us taking action and the effect on inflation. No, of course not. That is not what Powell was saying back in January of 2021. This is what he had to say. Here's a piece from CNBC regarding Jerome Powell's talking points at that point in time when the inflation rate was 0.4% under the Fed's target. So the Fed at that time kept interest rates near zero and doubled down on its commitment to buying massive quantities of bonds each month. That's from CNBC. Powell said that talk of tapering was premature and the Fed would have to see improvements towards its goal, meaning the 2% inflation target, before it would consider cutting back on purchases. Now, this is a chart of the Federal Reserve's balance sheet, and you can see that if we go back to January of 2021, when Powell said that, the balance sheet was around $7.4 trillion. So that's up from a bottom in 2019 of $3.7 trillion. So almost $4 trillion of debt that the Federal Reserve had bought up until that time to try to, goose the economy, get the inflation rate cranked back up following the pandemic and the closure of the economy, the artificial closure of the economy, by the way, which probably wouldn't have been able to have been accomplished were it not for the Federal Reserve creating massive amounts of money. But at that time, Powell said, we need to wait and make sure that inflation is rising fast enough. And yet today, despite the fact that, we're still 0.5% away from the Fed's inflation target, he's saying, nope, we can start cutting now. He doesn't say that talk of cutting is premature, doesn't say that we need to, keep on the fight inflation until we get closer to the goal. No, he says, inflation fight's over. Let's go ahead and begin cutting rates. And this kind of shows you the bias of central bankers towards inflationary monetary policy. They have one tool, it's a printing press. They have one thing they can do, that is debase the currency. And that's what the Fed tends to do. Do me a favor, if you're in the chat, I see a number of people leaving comments, you're watching the video, smash that like button, help get this information out into the algorithm, because look, you're not going to hear this from either candidate. You're not going to hear it from either party because they've both been complicit in the creation of this debt crisis. Now, some people might not want to hear that, but that is the truth. And that is evidenced by the fact that the past three administrations have inflated the debt bubble in the U.S. more than all of the presidents before them in history. 200 years plus of presidents didn't create as much debt as the past three. And, right now, on the ticket for November, you've got one of those administrations is going to be back in power, right? So no reason to believe that the debt bubble is going anywhere. And to show you the bias of central banks towards debasement of currency is this infographic from Visual Capitalist, which shows the debasement of the dollar since the creation of the Federal Reserve in 1913. The dollar today is worth about 3 cents compared to in 1913. And this only goes to 2020. This is a little older infographic. I thought it was interesting here, though. They put at the bottom this chart of what $1 will buy you. So in 1913, you could buy 30 Hershey's chocolate bars with $1. 1933, you could buy 10 bottles of beer. And it kind of goes down. You can see over time here. In 1997, you could buy 4 grapefruit. And by 2020, all you could buy was a McDonald's coffee for $1. That's all $1 will get you. But I thought this was interesting because, time has passed since this infographic was created. There's been a lot of inflation. So I found this site, Hack the Menu, which lists current prices on a McDonald's menu. So in 2020, you could buy a coffee for $1 today. I had to look this up because I haven't gone to a McDonald's in probably over a decade because I prefer to avoid poison. But premium roast coffee now, large, small, or medium, $1.69 at McDonald's. So I'm assuming that Visual Capitalist verified that a coffee was $1 back in 2020. That's a pretty significant increase, right? A 69% inflation rate in McDonald's coffees since 2020. And that's why, the PCE, the CPI, all these government numbers that represent inflation are total bunk. And it's designed that way to understate the effect of inflation. I mean, think about it. They're redefining words, folks, to obfuscate what is going on here. So, if you think they won't cook some numbers, you've got another thing coming. But, it's kind of good news for us gold and silver stackers because despite the fact that inflation is rampant, I think part of the reason that gold and silver remain so cheap, so gold at $25.13 today, both metals basically flat today, silver at $28.25, part of the reason these metals are so cheap is because it is being obfuscated from the general public what is occurring with the currency and with this debt crisis. So to me, this really represents an opportunity to get into these safe haven assets at discounted prices. It's not financial advice, it's just what I'm personally doing before the realization kicks in as to what is coming. And I think that following the Fed's meeting later this September and following the election, you're really going to see the money creation kick off into overdrive regardless of the outcome. And that's when you're going to see the gold and silver prices really moving. It's interesting, on the silver chart, you've got this kind of triangle that converges in November, right? So you would expect silver to break out of this pattern in November. Leave me a comment in the chat to let me know what you think will happen to the price of silver following the election. You think it's going to break out of this triangle to the upside? Do you think it's going to break lower? My speculation is that since the Fed's going to be printing huge amounts of money and deficits are going to be ballooning, that it'll probably be to the upside. But that's just me. Let me know what you think. So here's some further evidence that the amount of debt and money creation is going to be absolutely exploding. This is from today from Bloomberg. The Fed to cut big banks' capital hike in half in sweeping overhaul. So the Fed had proposed these banking regulations that would require an increase in capital that the banks would hold by 19%. Now, I'll just read this to you, I guess, rather than trying to summarize it. U.S. regulators will make sweeping changes to their bank capital rules proposal, cutting the expected impact to the biggest banks by half and exempting smaller lenders from large portions of the measure. This is according to Fed Vice Chair for Supervision, Michael Barr. He says that it would cut in half the 19% capital hike that regulators had planned for 8 of the biggest U.S. banks. So that includes Citigroup, Bank of America Corp, JP Morgan Chase & Co. They would now face a 9% increase in the capital that they must hold as a cushion against financial shocks. So what does that mean? Well, it means that these banks don't have to hold as much in reserve. That means that they can lend more out. They can take more risks. The banks say they need to do this to generate revenues. And of course, the problem here is that these banks, they can take on all these risks, right? They privatize the gains that they get from that. When they loan out money and they collect interest on it, they take all these risks with their capital. And if something goes wrong, the losses are made public because they get a bailout. These are all too big to fail institutions. We learned that in the great financial crisis, that basically any economic downturn, any banking crisis, you're going to get a bailout. They're not going to let these institutions fail. And what that means is not only are they going to be expanding the money supply by issuing more debt because they don't need to keep as much capital on hand, but they also likely will be taking on more risk, and that increases the likelihood that the Federal Reserve is going to have to bail them out, run the printing presses, create a bunch of money out of nowhere. We got a little preview of this in March of 2023 with the banking system failure that we witnessed then. That didn't turn into a systemic crisis, but only a matter of time, folks, when you have the system that we have today where, you're either going to run into crises, systemic crises in your financial system, or you're going to have to hyperinflate the currency away. Another example of why the Federal Reserve is getting into the market here and they're going to ease policy, they're going to cut rates, is because of the soaring interest on the U.S. national debt. This also helps to bail out the banking sector. It also helps to bail out the commercial real estate sector. But the biggest debtor of all is the federal government, the Treasury, $35.3 trillion in debt. That starts to add up when you have to, hike interest rates to fight inflation, start paying vast sums of money. Already, the interest on the national debt exceeds the defense budget. It's the third largest item on the federal budget. And if you take the Congressional Budget Office's projections at their face, this is the projection from the CBO of where the federal debt is headed in the future. By 2034, they say that the debt to GDP will increase from 99% today to 122%, the highest level at any point in history. And important to note, these forecasts, this forecast by the CBO, their projections, they don't take into account any kind of recession. They don't take into account any kind of reduction in tax receipts. What happens in a recession? Well, tax receipts go down and deficit spending goes up. because the Federal Reserve, or rather the Treasury, the U.S. government, through legislation and spending, is going to try to stimulate things. Who's going to buy all that debt? Well, it's going to be the Federal Reserve at the end of the day. And that's one reason why you're going to see gold and silver take off. This is, again, the Fed balance sheet. Ostensibly, they've been tightening. I think there's some question about that, whether or not they're actually still tightening. You see the decline that we've had recently in Treasury yields, and you kind of wonder who's been buying all the treasuries, right? So is the Fed running two books? I don't know. I mean, that's just speculation. That's neither here nor there. Let me know what you think in the comments down below. But even officially, this number is, well, it's going to be going much higher in the near future. Once the Fed eases monetary policy, they're going to have to begin QE or some form of easing once again, because the economy is in tatters. You've got $35.2 trillion in debt. The only way $35.36 trillion in debt. The only way you can ever pay off this level of debt, folks, is to debase the currency, right? So there's really two options right now. We can balance the budget. So that's not going to happen, right? We know that that's not an option. It's not politically viable. The government can default on its debt obligations. Also, not likely to be politically viable because it would result in a systemic collapse. So the other option is for the Federal Reserve to become the buyer and lender of last resort, monetize large portions of this debt, and pay it off. The way that works is the government can always pay off its debts, right? Because they can always just borrow more money, have the Federal Reserve buy up the debt that they issue. They could issue, say, a 100-year 0% interest treasury, sell a couple $1 trillion of those to the Fed. The Fed puts them on the balance sheet. The government pays off its existing creditors with that newly created money. Bada bing, bada boom, no problem. Of course, that's massively inflationary, and it would result in a lack of confidence in the dollar and in U.S. Treasuries as a safe haven. Now, why does that matter? Well, traditionally, the U.S. Treasuries have been viewed as, the number one safe haven asset. But when the hyperinflation, the debt monetization, the debt crisis reaches its peak, that's not going to be the case anymore. And what are people going to look towards as safe havens? Well, gold and silver would seem to fit the bill. And I suspect that when that day comes, you will see absolutely ballooning gold and silver prices. Forget paper derivatives, forget the SLV, forget the GLD. You're going to want the real physical metal in your hands when that day comes. And I believe that is inevitable. Perhaps it will be years down the road. Perhaps it'll be weeks. Perhaps it'll be months. I'm not sure. I know a lot of people, hear this sort of thing and they say, well, people have been calling for this forever and it's never happened. Well, it's been inevitable for a while. And, the deeper we go into debt, the more inevitable it becomes, and the worse the inevitable crisis will be, the deeper we are in debt. So if someone was telling you, gold and silver are going to soar, the government's going to default or inflate when we were $10 trillion in debt, when we were $15 trillion in debt, when we were $20 trillion in debt, I mean, they're even more correct at $35 trillion in debt. The only question is, how far can they kick the can down the road? And judging from a variety of factors, a shifting geopolitical environment, back in 2008, for example, when they began, the first round of quantitative easing, and they were selling, huge amounts of debt. They were borrowing a lot. Back then, China was a net buyer of debt. They're selling off their debt at a record pace right now. You had the U.S. dollar status as the world reserve currency was unquestioned back then, right? Now, that's a lot different. Even in 2020, when we had the pandemic and that intervention, the dollar status was much more certain at that time than it is now. We've got de-dollarization around the world. You've got weaponization, record levels of sanctions on the U.S. dollar, scaring those who would view it as a safe haven. So a lot of things are different this time, and it just seems like we're getting close to the end of the debt crisis, the debt bubble. It's going to reach a head here soon, and when it does, going to want to have some gold and silver. Anyway, let me know what you think in the comments down below about all the topics we covered today, about the ballooning levels of debt, the obfuscation of this crisis, from politics, from the dictionary even. Let me know what you think. Leave a comment down below. Smash that like button. Share the video with your friends. And I will catch you next time, everybody. Stay safe and happy stacking. Smart Silver Stacker out.